Welcome to This Explainer. Today, we're taking a really fascinating look at a company that, honestly, is fundamentally misunderstood by the wider market. We're going to break down a recent institutional-grade equity research report on Baladna. If you casually glance at this stock, you might just see a regional dairy producer. But, well, when we look at the structural mechanics mapped out in this analysis, a completely different picture emerges. We're actually looking at the quiet, steady compounding of a true sovereign food security platform. But real quick, before we jump into the numbers, I do need to read this verbatim. This research communication is not investment advice and does not constitute an offer, solicitation, or invitation to transact. Full disclosures and limitations are included in the report. Okay, with that out of the way, this institutional-grade summary is based on a comprehensive equity research report prepared by Vasro for investors and professional audiences. Okay, let's dive into the sum of parts analytical framework we'll use to deconstruct the company's valuation. We'll be hitting their food security infrastructure platform, the Qatar domestic engine, their international expansion into Algeria and Syria, the strategic investment portfolio, our sum of parts valuation, and finally, the risk framework and outlook. Starting with Section 1, Food Security Infrastructure Platform, Beyond a Single Asset Story. To really grasp what's happening here, we need to completely reframe how we view this company's core identity. So the absolute biggest misconception in the market right now is pricing Baladna as a standard commodity dairy business. When you look at ordinary dairy, what do you see? Thin margins, right? High vulnerability to global milk prices, heavy competition. But this report argues that Baladna is built as sovereign food security infrastructure. So what does that actually mean for us? It means vertically integrated systems that are literally built to guarantee a national food supply, often working hand in hand with government mandates. It's about resilience first, and ironically, building for resilience creates an incredibly powerful economic moat. And here is the proof right in the numbers, 33.8%. That was Baladna's underlying EBITDA margin in the first half of 2026. Now, why does that matter so much? Because the regional peer median for dairy companies sits at around 14%. Baladna is operating nearly 20 points higher. That is absolutely massive. And it's not a fluke. It's the direct mathematical result of infrastructure economics. When you control the whole shebang, from the farming to the processing and the distribution, your cost-based control is structural. It's not temporary. Moving on to Section 2, the Qatar domestic engine, the core cash generator. Let's look at the first of the 4 value pools driving this company, because this is the engine that makes everything else possible. This domestic operation is just incredibly defensible. Why? Because Baladna controls the entire chain in Qatar. We're talking from herd genetics right down to the cold chain distribution. Because of this, they hold the #1 market share in 6 distinct dairy categories. Just look at these figures. A staggering 90.4% share in fresh milk and 88.3% in UHT milk. But honestly, perhaps their most crucial competitive advantage is their route density. They operate 149 sales routes serving nearly 4,000 commercial customers. In a market the size of Qatar, that is a distribution mode that competitors simply cannot replicate efficiently. No way. And remember, this entire system was pressure tested and forged during the 2017 blockade and the shipping crises that followed. So this domestic cash engine is exactly what funds their wider regional platform. Which brings us to Section 3, International Expansion, Algeria and Syria. Now we're pivoting to the future, looking at the international engines that are transforming Baladna from a purely single-asset Qatari story into a massive regional player. And this brilliantly illustrates the sheer scale and strategic nature of their international ambitions. The Algeria project isn't just a farm, it is a massive, vertically integrated milk powder platform. But here is the absolutely crucial point for investors. This growth comes without the usual international risk. How? Because of a really unique triple guarantee structure. Baladna has secured a 20-year state offtake agreement, meaning the government is committing to buy the output. Add to that a 10-year tax holiday during the critical ramp-up phase and a 20-year bank payment guarantee. Plus, the Algerian Sovereign Wealth Fund is a 49% co-investor. This structure materially protects their pricing for 2 decades and severely de-risks the whole project. In the base case valuation, this engine alone adds KUR 581 million in probability-weighted net economic value to the company. Alongside Algeria, there's the Syria project. Now, it's a bit earlier stage, but as of the second quarter of 2026, it officially moved from the permitting phase into active construction at the Adra industrial city. It's a highly targeted, integrated industrial dairy plant aimed at capturing 20 to 25% of Syria's domestic dairy needs. While it's smaller than the Algeria megaproject, it clearly proves their model is exportable and scalable across the region. Section 4, the Strategic Investment Portfolio, the Hidden Balance Sheet. We call this the third growth engine. And honestly, this might be my favorite part of the entire report because it is so heavily overlooked by the wider market. Sitting right there on Baladna's balance sheet is a strategic investment portfolio with a fair market value of QAR 1.303 billion as of mid-2026. This isn't some theoretical projection, guys. These are quoted equity investments. The absolute crown jewel here is a 16.25% stake in Egypt's Johanna Food Industries. This gives Baladna massive strategic exposure to Egypt, which is the largest Arab dairy market by population, without having to buy and run a whole company from scratch. Because traditional valuation models focus purely on operating cash flows, they often assign almost zero value to this QAR 1.3 billion asset. It's literally a second company hidden right in plain sight. Let's move to Section 5, Sum of Parts Valuation, the financial anchor. So how do we actually price a company that has a domestic cash cow, guaranteed international megaprojects, and a billion real investment portfolio? Well, we have to use a strict sum of parts valuation, anchoring all our figures strictly in Qatari rial. Now, what's really interesting about this slide is how methodically the target price is constructed bottom up from all four of those parts. The domestic Qatar platform provides the solid bedrock at QAR 1.05 per share. But look right below that. The strategic investment portfolio adds QAR 0.64. That is a massive chunk of value. Then we add the probability-weighted optionality for Algeria at QAR 0.22 and Syria at QAR 0.05. Finally, factoring in the proceeds and deployment from the recent QAR 541 million rights issue gives us another QAR 0.23. Add it all up, and this creates a base value of QAR 2.18. When Vassar applies their scenario weighting framework, it lifts the final target price to QAR 2.43 per share. So you can see, looking at this stock through a single asset, pure domestic dairy lens, completely misses the bigger picture. Section 6, Risk Framework and Outlook. A delivery-led year. Of course, no institutional analysis is complete with a rigorous, neutral look at the risks. The research notes that the current phase is less about a narrative reset and entirely about being a delivery-led year. It's all about execution right now. Investors don't need surprise upside. They just need to see these verifiable markers hit. Syria construction commenced in Q2. The portfolio was cleanly marked in June. The rights issue closed in August. But the major milestone on the horizon, the one we really need to watch, is the massive airlift of 30,000 Holstein cows into Algeria beginning in November 2026. Yes, you heard that right. A literal airlift of 30,000 cows. Hitting these massive logistical milestones is what will force the market to finally price in those international engines. And Vosro is very clear about the real execution risks being tracked in their financial model. First, Algeria is a massive logistical undertaking. Airlifting tens of thousands of cattle and building out the plant must go smoothly. Second, building a plant in Syria naturally comes with geopolitical sensitivities that could cause delays. Third, that QAR 1.3 billion strategic portfolio is tied directly to the equity markets, meaning it's fully exposed to mark-to-market volatility swings. Finally, domestically, while they hit that amazing 33.8% in the first half of the year, sustaining an EBITDA margin above the 28% warning level through normal seasonality is just an ongoing operational challenge. We'll wrap up with this crucial reminder from the report. All forward-looking statements are operational targets yet to be earned. At the end of the day, execution is everything. For the complete methodology, deep dive disclosures, and the full financial models, we highly encourage you to read the full Vassaro Equity Research Report. But I'll leave you with this final thought to chew on. As regional tensions occasionally flare up, the drive for sovereign food security in the Middle East is no longer just a policy aspiration. It is an urgent, well-funded necessity. And as we've seen today, the value of the infrastructure platforms built to deliver it might be quietly compounding right under the market's nose. So the next time you look at a stock in this sector, you have to ask yourself, are you just seeing a product on a supermarket shelf? Or are you missing a sovereign infrastructure engine hidden in plain sight? Thanks for joining me on this